The next short series of videos deals with red flags, things that could go wrong with shares that you're currently invested in. And what I want to do is start with acquisitions. Now, acquisitions can be brilliant, can be good news, can be a quick way to grow a company, but watch out, because there are one or two tricks management can pull using acquisitions, and I want to flag up one or two warning signs that things might be going a little bit wrong and that management have got carried away with themselves, overpaid, bought the wrong sorts of firms. Right, so be vigilant is the message from this video. Management want you to believe their growth story. They will do anything to make sure that the top line sales figure, the earnings figure carries on rising in the way they want to portray the company growing. Growth for them means rising sales and profits. That's the picture they want you to take away. Healthy skepticism is the key to successful investing, not pessimism, not never buying anything, but healthy skepticism, keeping your eye on the ball. And red flags are one way of identifying potential trouble. At the very least, they provoke more questions. So, what about acquisitions? Well, no one wants to be an accountant from these videos, so I'm not going to turn you into one. Really, it's the warning signs at the end you want, but just to give you a flavour as to one way management can use acquisitions, not just to grow a firm, but also to pull the wool over your eyes a little bit. Let me just highlight a couple of features of one company buying another. So imagine you've got company A goes out and buys 100% of company B. Very, very simple example. All right. Now, it doesn't have to buy 100% to get control of company B. It's going to buy the voting shares. 100% would do it. All right. It could buy as little as 50% plus one and still control the annual general meeting of shareholders. The point is you don't need to own all the voting shares to get control, but I'm going to assume here company A has done exactly that. So basically it has bought out company B's shareholders by making some sort of offer to them, cash for example, and it now controls company B. The accountants, not unsurprisingly, now want these two companies to present their results together. All right, they now become a group. And the idea is that because company A owns all of the voting shares of company B, it can do now what it wants with company B, even though strictly speaking they're separate legal entities. Company A effectively controls the AGM. It can make decisions about the board of directors, major strategic decisions, and so on. So you combine them together by basically adding up their profit and loss accounts, balance sheets, and cash flow statements to present the group picture as though A and B were in fact one entity. All right. Now, it's there that the opportunity lies for management to pull the wool over your eyes. So I'm going to take a very simple example. I'm going to say, well, let's imagine that we're looking at a 3-year period in total. In the middle year, and you'll see what I mean in a moment, we're going to assume that A bought B exactly halfway through the year and bought 100% of B. So there's your scenario. A wakes up one morning and decides to buy 100% of B, 100% of his voting shares, bang in the middle of the year, and we're going to assume, let's say an accounting year end of December, halfway through the year would be June. What would that look like as far as the group picture is concerned? Well, a lot of numbers here, but let me paint a picture. Let's say the parent, this is just jargon, that's company A in my previous example, makes profits over the 3 years I'm talking about of a flat 500 million. So there it is, 500 million in year one, 500 million in year two, 500 million in year three. And remember, the acquisition of B is going to be exactly midway through year two. Remember that, 100% of B is being bought by A midway through year two. So year one, it's just all about A. Halfway through year two, A buys 100% of B. So in year three, it's A and B combined as a group. A now owns B. Now watch what happens. The target company is B. All right, so you've got two companies in play, parent A, target B, and I'm going to say that B's profits are also flat. 400 million in year one, 400 million in year two, and 400 million in the year after acquisition. All right, here's the trick. Let's now produce the group results. So, well, company A was always part of the group for all 3 years. So company A's contribution to the group, that's presenting A and B together, is 500 million, the profit it makes in each year. But look at company B. Remember, this one's A, this one's B. Now, have a think about it. if company A buys 100% of B midway through year 2, in year 1, B cannot make a contribution to the group because it wasn't part of the group in year 1. A hadn't bought it yet. All right? So its contribution to the group, 0. Now, A buys 100% of B halfway through year 2. B's contribution to the group can only be the profit it makes from the date of acquisition. Yeah? So that's got to be half its annual profit of 400 million or 200 million. All right, that's B's contribution to the group because it's only part of the group from midway through the year. So 100% of its profits from then on, 200 million. And of course, in year 3, A and B are presented as the group for the whole 12-month period. A owns B all the way through that 12-month period. So when you're producing the group, adding up their balance sheets, adding up profit losses and so on, you just add them together and that gives a contribution of 400 million, all of B's profits. Now, add those together, so that's contribution from A and contribution from B once it becomes part of the group, and here's your overall group result. Group profits year 1, 500 million. Group profits year 2, 700 million, 5 plus 2. Group profits year 3, 900 million, 5 plus 4. You might be thinking, so what? Well, here's the so what. These companies are not actually growing their profits individually. We said that at the beginning. But because of the way you combine the companies together to get the group, you can produce what looks like a growth profile almost out of thin air. All right? Because you've got 500, 700, 900, and that's an upward group profit trend. All right? Almost conjured out of thin air. Well, conjured out of the way in which the companies are combined together to get the group. Now, there would be some disclosures. Picky people out there will say there are some disclosures about what proportion of B's profits have been combined into the group. Yes, but whoever reads through those notes to find them, I'm saying in the group profit and loss account, you could be misled. Is this a motivation for companies to go out and buy the companies? You bet it is. All right, because it presents the kind of growth profile that you'd hope analysts and investors would see through, but often don't. That's just one example of how acquisitions can be quite handy. Okay, you don't want to be an accountant. So what to look for? Warning signs. You're looking at a company, what would give away the fact that there might be danger signs, that profit may not be quite what you think it is. Fast expansion by acquisitions. Acquisitions are a quick way to grow, but they're also a great way for a company to improve the profits profile and potentially even the sales profile that it shows you. If a large proportion of the balance sheet is intangible assets, there's another warning sign. Goodwill. When one company buys another, as I deal with in a different video, you get a thing called goodwill, an intangible asset, resulting from the fact that companies often pay more than the book value of the assets in the target to get hold of them. That goes into the balance sheet. You see a lot of that going on, goodwill being added to over time. Watch out. Big goodwill impairments, probably the biggest one. That's when companies realise they overpaid in the past, realise they've got it wrong. The company they bought isn't worth as much as they thought it was going to be worth in future earnings and cash flow terms. So they have to write chunks of it off. All right, and that's probably the biggest of the 3 warning signs there. So there you have it. Acquisitions can be good news, but can also be a way for a company to slightly paint a different picture to the true underlying one. Keep an eye on those warning signs as you read the accounts.